Good morning, everyone. Thank you for joining us this morning for our webinar. Today's topic is going to be detecting and addressing financial stress on the farm. As a quick reminder for all of our attendees, you are muted and the videos are shut off. However, we would love for you to engage with our presenters today by using the chat feature found at the bottom of your screen. So our graphic here shows how you can find the chat feature, whether you are joining us from a computer or from a mobile device. You'll click those three dots on the bottom of your screen and select chat. Before we begin, I would like to introduce our experts on the call today. We have David Widmar and Dr. Brent Gloy, who are co-founders of Agriculture Economic Insights. And then we are lucky to have our very own Jody Wade, who is the Senior Financial Officer here at Farm Credit Mid-America in Tennessee. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. Any opinions expressed by presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you for joining us. The event will be recorded and distributed following the webinar. So good morning, Brent, David, Jody. So glad to have you guys here. Brent, I'm going to pass it off to you to get things started.
Thank you very much, Claire. It is great to be here today. It's a beautiful morning here in Southwest Nebraska where I live. I'm in the mountain time zone, so still pretty early here. Um, I hope everybody has had a really nice summer there, wherever you're at. Our topic today is one that's you know, doesn't sound the most enjoyable, detecting and addressing financial stress on the farm, but I think it's really timely and it's really important. As we all know, economically, things are tight in the farm sector right now. And one of the things we wanted to do is provide some tools and frameworks to help people think about being proactive, about trying to detect that sources of the financial stress on the farm and come up with some proactive ways to improve it. Because as I've always said, it doesn't do us much good. I mean, we know when there's a problem, but we want to pinpoint. What we want to do today is help you try and pinpoint where that problem's coming from and come up with some ways or some ideas probably to get you started to addressing it if that's the case. So as we look around the farm sector, David and I follow this stuff pretty closely, and I will say, the warning lights are flashing, and they're flashing red now. It's not a flashing yellow; it's a flashing red. Um, and one of the things that's causing that is that when we look at net cash income, I've got two charts up here on the right side of your screen. The first one is crop cash income for corn in orange, soybeans in gray, cotton in yellow, and wheat in blue. And one of the things that I would say is that um, it doesn't happen real often that wheat is not the lowest of those cash indexes. I mean, honestly, if you look through their wheat, a lot of times it's toward the bottom of that. But corn and soybeans are really, really quite low. I mean, you look at that soybean number, and that's for 2020 forecast for 2025 to be about 50% of the average over the last 7 years. That's tough. And it's way lower than it was in 15 or 18. And compounding that is that the heartland region, which Mid America would be a big part of, uh, is kind of the epicenter of that, and that's the bottom chart, and it shows the cash income index for different regions of the country. Heartland in blue, Northern Great Plains and Prairie Gateway are the others. And one of the reasons that those other two I think are a little bit better is a little bit more prevalence of livestock in those areas where livestock returns have been a lot better. And so that's one of the things that's probably helping those regions. But the heartland is kind of epicenter of this just due to the corn soybean dominance there. So today we want to give you some tips for detecting that financial stress and some steps for fixing it. So let's let's go ahead to the next slide. And I always say, how I know I've got a problem with something, it doesn't matter what it is when I wake up in the middle of the night and that's in my head. Okay. And I like my sleep. And when I don't get sleep, I know something needs to change. And so it's kind of that, what's keeping you awake at night? The first thing is, are we having trouble getting our bills paid on time? Is that, we're worried about, making our payments, whether it be accounts payable or debt. And what we want to look at in that situation is our cash flow. And so we're going to go to the cash flow statement and ratios related to cash flow. Are we worried about, hey, we're not going to get to these price revenue targets? And I know after the report the other day and where prices are at today relative to where they've been the past few years, some of our price and revenue targets are just out the window. Okay. And there we want to start looking at yields and commodity prices. And when we do that, we want to focus in on our crop budgets and our income statement. And so those are the financial documents that we're going to go to in that situation. And then is it okay, maybe our equity is showing some weakness and it could be related to debt, could be related to value assets, but we're going to find those answers on a balance sheet. So let's get into that. The first thing we want to ask is, we were doing this beforehand. We were talking about this with our group, and our lender expert said, one of the first things we want to do is get a look at, how updated are your financial statements. And I think that's really good advice. And the first thing we want to do, I think, is start updating our crop budgets. And one of the most important things you can do is, you all put together a budget last year. If you didn't do it last year, we want to do it next year. When we can compare where we're at relative to our budget and start to ask some questions. Okay, why am I over budget here? What happened here? What could I do maybe to limit that in the future? Is there something going on here systematically that needs management attention? And then secondly, we can start to look at our current price and yield expectations, because we started a budget last year and we have to put in a price and a yield. And those are uncertain things. And now we've got some additional prices. Maybe we've done some marketing so we can start to firm up our marketing price targets. Maybe we haven't. We have to kind of adjust them to the reality of where prices are today. On yields, we're starting to get to that point in the season where we can get a pretty darn accurate picture of what our yield expectations are. I'm not going to say you're going to hit it perfect, but most of you are in the fields enough and know your operations enough to have a pretty good idea of what kind of a crop you have out there. And so we can start to get a sense of, okay, how much crop am I going to have? How much do I have unsold? What do I have to do? What's my plan for um, managing maybe the excess that I don't have sold, don't have storage for, etc. And then we want to scale that to look at some annual income projections, look at monthly cash flows, and even our end of balance sheet conditions. And so we can take and project that. Now, this all starting to sound pretty hard, isn't it? But you've got resources. And one of the things that you can do is talk to your financial officer at Farm Credit to help you with this, because this is what they do. They have a lot of experience with this, and they can help you get this into some actionable materials. So the third, and then once we've done all of that, then we can start to look at our financial ratios. And that's where we want to, there's a really good tool from our friends at the Farm Center for Farm Financial Management at the University of Minnesota. They put together this scorecard, and it's kind of a red light, yellow light, green light thing, and it goes through the different areas of financial performance, whether it be liquidity, which we've highlighted, solvency, profitability, repayment capacity, which is another one that we want to really focus on right now. And it's got a bunch of ratios, and you put your ratio in, and it kind of gives you a sense for, hey, where are we at relative to what those folks say? And what I would say is, along with this, we'll send this out in the materials that tells you how to calculate each of those ratios. But also, again, encourage you to work with your financial officer to talk about calculating those ratios. They're really good at this kind of stuff. You pull them in to help you get those calculations, and then we can start with where we're at in 24. What are the concerns of the beginning years, and what are some plans that we have to address those? And then, if possible, let's move to 2025 and say, okay, what's getting better on here? What's getting worse? And what are our priorities for addressing this? And let's start to get a plan for addressing some of those problems, which is where the real meat of this activity goes. I mean, it always annoys me when people say, well, we just got to get a lot of working capital. We know that. Uh, it's what do we do when we don't have the working capital? It's a bigger question. Let's get a plan for moving forward and solving those problems. And that's what David's going to talk to us a bit today about.
Yeah, thanks, Brent. I think it's really important that you start with the steps that Brent outlined, and that's going to help you go from this ambiguous angst or maybe this idea that's waking you up in the middle of the night, and you're starting to turn this into a specific financial measure or a specific financial ratio that you're going to really start to focus on and you're start to move forward. There's that business management idea that what gets measured gets managed. And so we really want to tie this financial concern that it's going to be different for every operation. But the idea here is how do we turn it into something that's specific and measurable? We understand if it's a cash flow or income or balance sheet situation. And then we could start moving to the next step of this conversation, which is addressing the challenges. And we've broke this into three sub steps. The first part is identifying options. And so we're going to start with a blank sheet of paper and we're going to start listing down how might I be able to solve or improve the situation that we've identified earlier. The second piece here is we're going to take those options and turn them into a plan. And that could be a short run plan, there could be a long run plan, but the idea here is we're going to put together a plan that then we can share with our stakeholders. That could be our family members, that could be our trusted advisors, like our lenders or our accountants. And that's going to be something that we're going to tweak and adjust, and we're going to dial that plan in, and then we're going to work to execute. And a lot of times, that execution of the plan requires some accountability. It's personal accountability on our side. It's accountability from our teammates to make sure that we're all making progress towards this goal. We're all on the same page. We're all, rowing that boat in the same direction. But also, it's always helpful to include those trusted advisors as part of that plan because they can help nudge you along too, or maybe they come up with an idea that helps you make progress towards that plan even closer. So step back and say, "I- once I've identified or detected the challenge, how can I go through and start to address it? Identify the options, create the plan, execute the plan." And what I have on the next slide here are some potential options. And so we always talk about the blank sheet of paper being one of the most intimidating parts of creating any plan. So we have a few ideas here on this next slide, and you can figure out which one of these might be most appropriate for your operation given the challenges that you've identified. And so some of the potential options are listed here. I think the first one on the list is one that happens almost automatically in a lot of cases. We see this throughout history of the farm economy boom and slowdown cycles. We see capital purchase plans get deferred or get put on pause. And so we're just not going to replace the machinery as quick as we might have the last few years. So there's a couple phases to that. Maybe one part of it's getting back to normal, but then maybe there's another more aggressive form of that deferred plan, which is actually, we really should have replaced this piece of equipment, this combine, for example, but we're just not going to do it. We're going to keep that piece of combine on longer than we had done in the past. And so defer versus sort of an even more aggressive form of that. The second level here is revisiting cash rental agreements. I think a lot of times there's a lot of focus that goes into what's the appropriate cash rental rate. We have not seen widespread downward pressure on cash rents yet. There's been some change here, but I think this cash rent conversation is going to be front and center over the next year or more. But I think what we want to challenge you to do is get more specific than just that payment rate. Maybe it's time to revisit that structure. Maybe if you're on a 100% cash rent agreement, maybe you can find a win-win situation with your landowners by offering a share agreement, or maybe there's a bonus structure that allows you to make sure that your landowners do participate if farm incomes, uh, commodity prices, or yields get really strong in the future. So you don't have to kind of keep revisiting that every few years. So think about the structure, think about those payment rates. I think the third piece here is maybe the timing of the payments. Those timings can vary geographically. We've heard, kind of think the rule of thumb is 50% is due at planting, 50% is due around harvest time. But we hear all types of differences, maybe 100% at the beginning of the calendar year, or payments happening at or after harvest. And so there's some flexibility there. That might be an opportunity for you to create some improvements for your operation on the cash flow side, but also helping your landowners as well. I think there's some other considerations. Maybe there's some improvements that need to happen on the land. Maybe some tile that needs fixed, or a fence row that needs improvements. And so maybe there's an opportunity for you to either get some discounted rent, or actually do some custom work to help get that land in a good shape. The third idea is to critically evaluate some of those underutilized assets. During the profitability eras, maybe you took on some ventures that now didn't maybe line up with your expectations. Maybe you bought a bigger planter thinking you could do some custom planting, and that really didn't work out. Or maybe you started spraying your own crops because you were trying to save some tax bills, so you bought this bigger sprayer, and maybe it's time for you to revisit that. Maybe it's you work with a local co-op again to get your crop spray. Maybe it doesn't make sense for you to be doing that given the value of that assets. The fourth piece here is one that you hear a lot: cut costs. There's two components here. There's variable costs and there's fixed costs. I think in a lot of cases, these fixed costs, these are the ones that we as producers have a much more control over. We can't control where fertilizer prices are going to go, or crop protection prices are going to go. Those are easy to benchmark. Variable costs are really easy to benchmark. They're really easy to express our frustration if we perceive that those prices should be lower, or that maybe our neighbors, we perceive our neighbors getting a different price than we are. But fixed costs, they're about, we've looked at this throughout history. It's more than 50% of our total costs for raising corn and soybeans are those fixed costs. They're hard to benchmark, but there's a lot of areas for improvement that can happen in that fixed cost structure. And lastly, this is a little more challenging in this downturn than it was during that 14, 15, 16, even into 2017 downturn. Opportunities to restructure debt. There might be some opportunities there. This is where you need to have a conversation with your financial officers, but a higher interest rate environment doesn't make this option nearly as appealing. So that's adding to some of the financial struggles, or financial stress, I guess, is that this tool, restructuring, was much more popular, much more feasible last time than it is this time. One of the things I want to challenge you to think about with this list, and any list that you create, make sure that you create your own list and you line it up with what works well for your operation. The challenge is that you're going to have to balance sort of the easy versus the difficult changes to make, with also the potential magnitudes that they're going to have on helping you make progress. There's this game show in the 60s and 70s where there's a lot of guessing had to happen. And one of the recurring guests would always try to ask these questions like, is it bigger than a bread box? Is it bigger than an elephant? He was just trying to figure out what's the magnitude of what we're dealing with as we try to size up this problem. And I think that's a good way to think about this financial situation that you might be finding yourself in. Do you need to make small changes, or do you need to make really big changes? We need to make sure that we get the right treatment given the challenges that we're facing. One situation here is offloading underutilized assets can be really hard. That can be a really hard decision, but it could also have a really big impact on our operations in the short term, and also in the long term. We think about freeing up some cash flow or getting some cash back into the business. So my last slide here for us to work through is to summarize here before we get to our lender conversation with Jody is you don't have to do this alone. You have your family members, you have your team members, but you also have a team of advisors, trusted advisors. You also have maybe some hired professionals. The intuition might be to not hire a CPA in this lean years, but maybe it's time for you to get that CPA so they can help you with getting better cash flow projections. The second point is I want to remind everyone that financial stress isn't failure. That stress is sort of a signaling mechanism to tell us, hey, things aren't going right. We need to step in and make some management changes And the earlier we can make those changes, the easier it often is for us to make those course adjustments. The third idea is get specific. Avoid those vague sort of financial stress concerns. Get specific about the challenges and the magnitude you face. Is it income or cash flow or an equity situation? Are we talking about building, getting a $50 an acre cost savings or $150 per acre cost savings? Those will require different management approaches. The fourth idea here is don't delay. I think one of the temptations might be to wait until tax season when we get that first glimpse of what our accountants pull together, and that's going to delay a lot of the decisions that we can make. So in general, we have a lot of more time to plan, especially around cash flow. The more time that we have, the more projections we have, the more options we often have to help us get through those lean situations. Last but certainly not least, is communicate early and often. Communicate with your lenders, communicate with your family members, communicate with your trusted advisors. Make sure everyone knows what your goals are, what you're making progress towards, and what those actions, those management actions that you're doing, and how you think all those pieces fit together. And that's going to help you make some progress and hopefully work towards those goals here in the short term, but also over the next few years. So at this point, we're going to switch gears here, and I have some questions for our lender expert this month. Jody, thanks so much for joining us and chatting with us today. I look forward to our conversation here as well, but also thinking about what we're going to do here in this conversation, how producers can turn this into their own conversation that they have with their lenders. So before I get there, I want to have you introduce yourself and tell us a little about your role with Mid-America. Jody, I think you're muted.
Good morning. I was muted. Thank you. I had muted the phone, not muted the computer, so I just had to turn a few things on there. So I'm Jody Wade. I'm a senior financial officer with Farm Credit. I've been with Farm Credit for 13 years. Been in the ag industry, loaning money to farmers for 33, almost 34 years. And my task is kind of to meet the customers at the ground and try to help them plan each year, get their financial statements prepared, help them with credit proposals and such. So it's a really neat job. I've found that the people of ag are the salt of the earth folks, so it's usually really, really good folks to deal with in this industry.
I appreciate that. When we were preparing for today's event, I asked you a kind of early question is, what have you seen that's worked well for producers who are wanting to detect and address financial stress? You had a great response. It was be honest, be open, and be willing to make adjustments. Can you elaborate about that here for us today?
Yeah, so being open or being honest is taking on just a few minutes to self-evaluate of where you actually are. And there's some tools that we actually have that we've been working through with producers each year, doing a year-end balance sheet, seeing what the trend is there, kind of capturing those expenses and seeing what trend lines they may have, what those items are telling us, but embracing that knowledge and then actually putting it to work for us so we can kind of plan for what may be coming in the future. The be open part is being transparent. If I'm transparent with my lender, I'm telling them everything that's going on. Not only the debts that I may have with them, but debts that they may have with other chemical companies, other banks. If I know the whole picture and my customer is willing to share that with me, it's easier for me to help provide a solution or a plan to be able to help them through these challenges. The most important one, I would think, would be the willing to make adjustments. And when I say willing to make adjustments, there were a few things that you and Brent had said about trying to find things that we can adjust. And they may not be huge things. They may be small things, but what we've figured out over time is small things add up. When small things add up, they have an impact. And when they have an impact, hopefully it's going to be a positive impact to hedge to get to a better place financially and be prepared for what's to come. So if we're willing to do that, we can always seem to find some way to make a greater impact for the good.
I mentioned at several points in my comments about the value of the trusted advisor. Lenders or financial officers like yourself are often in that role as a trusted advisors. Tell us how producers can best leverage that relationship they have with their lenders to get the highest ROI out of the time they spend with you.
Yeah, and so when we were kind of discussing this, I gave a couple of examples. Back in my earlier years, I had a customer, and this was a poor example. So we can always learn from good and bad examples. For example, the customer got through at the end of the year, didn't really plan through the middle of the year. When he got to the end of the year, he came in to sit with me to do it as an analysis of how the year went. And he literally brought a shoebox with all his receipts in it and said, "Here it is." And I said, "Well, what's this?" And he says, "We got to add all my stuff up to see where I'm at." And I said, "Oh, let me push the box back to you and let you add all the expenses up. I can help once you get this stuff dissected. But I need you to embrace what you've got here and give me some really good data." And he was a little upset, but what I found is by me pushing back a little bit, he ended up becoming a really great manager and is still one of my customers today. And he embraces that and he does that correctly. And some of the other customers I have that do this extremely well is they prepare their December 31st balance sheets every year exactly at the same time. They break down how much money they spent on each expense: seed, chemical, fertilizer, fuel, repairs. They do all those things and they capture it almost like if they were doing their taxes already. They break down how much income that they made from each crop, what their yields were, what their average prices are. And they give those documents to me at the end of the year, or, somewhere around January the 15th. So that's my best case scenario producers that are jumping out there, they're embracing the data, they're going ahead and writing it down, like you said, not necessarily on a blank piece of paper because they have a schedule of where they can do this pretty easily. But that gets them far ahead in the game to be able to have those conversations with me, their accountant, or any other advisors or family members that they need to be speaking with.
If a viewer today wants to have a conversation, watches today's webinar and it comes in the chat with you about where to get started, what would you challenge them to think about?
So I've had customers in the past that we've not touched base for a while, and they're looking at maybe doing some type of purchase or whatever. The first thing that I would ask them to do is, "Hey, when's the last time you prepared a balance sheet? Is it pretty recent? If it's more than 6 months old, probably let's do a refresh on that to see where you are right now." The financial statement always gives us a good idea of where you are from a liquidity standpoint, how much of each asset's actually yours. And I try to explain that to the customer with that solvency number, whether it be 50 or 80. That's how many cents of each dollar is theirs. And then the debt is how much somebody else how much they owe. So if I can give that to them, and that way they can kind of understand where they are financially from a perspective of how many dollars do I have of that total net worth or that total asset picture versus how much does the creditors have. The other thing that I would probably encourage them to do, and we're doing some of this right now, I'm actually reaching out to customers and actually doing some mid-year margins. And I had a little bit of pushback on this last year when I started this process because the customer was like, "Well, hey, why are you reaching out to me before I get done?" And I'm like, "Well, I'm concerned. I want you to succeed. I want us to go ahead and start identifying areas that you may be able to make us some adjustments, but to just kind of project where you think you'll be." And the thing that was very revealing was, in the case of this customer, he was worried, but yet we were able to kind of cast some of that worry to the side because he had already seen kind of like Brent was talking about, we already kind of knew what the yields were going to be. He kind of knew what the prices were going to be, so we could go ahead and get those things platted out. And when you started putting those expenses and debt payments, he actually had a margin and was going to be okay. So planning ahead for that now and going ahead and updating those balance sheets right now just gets you prepped for that year-end balance sheet that's coming up, 4 months from now, or just a little bit less than that. I would probably determine if there are any, like you said, non-essential assets that are sitting on my balance sheet that may not be producing income. They're not adding anything to the bottom line. It might be time to consider offloading those just to get some capital raised to help to, get that margin improved. Probably let your lender know and your accountants know what's going on. I had a recent visit with one of my customers, and he said, I'm having some challenges, and my accountant and I had some visits, and I was really encouraged that they were already having this conversation, because usually we think of accountants being the ones that help mitigate the tax, and that's really the only thing they're thinking about, when in this case it ended up being a really great conversation of, hey, I'm seeing your expenses in a different place than they've been in the past. Hey, how do we make some adjustments to try to keep those in line and keep them in a healthy place?
Last question I have for you before we get to the viewer questions is, I've asked a lot about strategies that work, but I want to ask you about the other side of the coin. What are some guaranteed not to work strategies that you've seen used and you want producers watching today to avoid?
Yeah, one of the poorest strategies that I've ever seen is just stick your head in the sand and just wait it out. Don't do any planning. And the problem with that is it does, you've got all this time, and I think so many people fail to realize there's only this certain amount of time that we have to plan, to live, to build income, to do whatever it is. We only have so much time to do that. So we don't want to waste time by just waiting around. So that's one of the poorest strategies I've ever seen. One of the other strategies that I've seen utilized, and it's not a very good strategy either, when it comes to those planning times, and you made the mention of trying to get ready for 26. Go ahead and start making budget projections. Try to identifying cost. One of the poor strategies would be, let's start clipping our fertilizer down. Let's not spray as often. Let's maybe go with a less seeding rate, in hopes that we can trim expenses, but there's always a terrible consequence. We're not gonna we shouldn't expect to get the same level of production than we would have if we would have used what was recommended. We certainly don't want to put ourselves in that box. I've seen it happen so many times, and when you get to the end of the year, you spent less money, but you made a whole lot less money too. So your margin's negatively affected that way as well.
Well, Jody, thanks so much again for helping us prepare, for joining us today. And I'm going to hand it back over to Claire now. She's going to wrap it up and field any of the questions that we've had coming through from today's viewers. So thanks again, Jody. Claire?
Yeah, absolutely. Thank you, guys. For our attendees, remember you can engage with us by chatting. So if you will drop your question in the chat, we will get that answered for you. We're going to start with Jody. We have one for you, actually. And the question is, if you're somebody who's new, you are a young farmer, you are taking over the operation, or you're getting into this, what can you do right now to set yourself up for success in the future?
Yeah, so I think one of the things that Brent and David and I all agree on is preparing a plan and trying to set out what is it that we're trying to do with this particular operation. What size are we going to be? What products are we going to focus on that make us the most profit margin? Obviously, that's sometimes hard to do. So not only engaging the financial officer, whoever that may be in your area, maybe getting somebody that's a financial expert that works in those commodities that are on your plan to help you get the best cost structure. One of the things that we addressed with a customer back several years ago was he had been in the business, but he was kind of new, but he only had one vendor. He was very loyal to that vendor. And one of the things that we did was we said, hey, take a moment and write down every expense that you think you'll have in regards to the products that you'll have for your operation, and write that down and carry it to 3 suppliers and get a price on all these things. And guess what this customer was willing to do? He did it. He embraced the challenge and he took that to 3 different companies. He was a pretty large producer. He saved over $250,000 by varying from staying completely 100% wholly with that one company and actually, buying product from 3. And it made a huge impact on his bottom line by having freed up that much cash. And he didn't let any expenses go. He just picked up the ones that were less expensive. But that would be the major thing that I would be looking at. And I would obviously look at things that are, good commodities to go in right now. That's a hard conversation to jump into row crops, which has took a hit. Be willing to diversify that operation and think out of the box and look at some other products that may be willing to make a better margin.
Thank you, Jody. Brent, so you talked a little bit about financial ratios as indicators of stress. Is there a certain one that you would pay closest attention to or really try to highlight if you are a producer really trying to determine your own level of financial stress?
Well, I don't know if there's a particular one. What I would do, I think that diagram lays it out really nicely. I would calculate those ratios in all those areas. And to start with, though, I would start by looking at my liquidity. So you want to look at your current ratios and those kinds of things. So working capital, how much working capital do you have relative to your expenses that you're expecting for the coming year? How much are you going to need to borrow? But then I really like repayment capacity metrics because those are going to tell you what your cash flow is relative to how much debt you have to repay. And those are really, really important for, hey, maybe I feel like things are a little tight right now. We want to get into those, even before you take additional debt. But ultimately, so talk a little bit in a circle here, but ultimately the profitability numbers are the ones that are the most important because profitability drives everything. We can generate cash flow in any one year by just selling a whole bunch of crop that we don't normally sell in that year. But profitability pays the bills over the long term. And that's where I think we really need to focus in the long term is, what do your margins look like on an acre of ground? What are you making and what can you do to improve that? What's your fixed cost structure? Your overhead costs. Are there things you can do to bring those down? So dig into that profitability numbers. Those are the ones that I think, and I'm talking about accrual adjusted profitability. So accounting for your inventory changes, because otherwise you're just looking at cash flow. But those profitability numbers are the ones that drive your success in the long run.
Thank you, Brent.
Do you have anything to add?
I think it's a great way to start. If you don't have great projections for 2025, start with 2024. Go back and use 2024 data. That could be the best place to get started. And then strive to get those 2025 projections and then final 2025 numbers in place.
Jody, one for you that came through the chat says most of our producers have had 3 years of losses on the farm. What do you recommend to those producers who have no room in their balance sheet to pivot?
Whew. It's tough call. You know, ag's like any other business. And I think what Brent is talking about when it comes to that profitability thing, that is the thing that drives us to be able to get to the next point. Are we looking at crops that are profitable to put pesos in our pocket and actually pay the bills? When I said be willing to make an adjustment, you know, I think it's been said that doing the same thing the same way and expecting a different outcome is insanity. Well, it generally is, because I mean it's hard to keep doing the same thing without making some adjustments. A lot of people are looking at, you know, alternative crops. You know, one of the guys that I talked with yesterday, everybody else is looking at $4 corn, and he's looking at selling his corn to a dog food company, which is a little different than your local granary. And, you know, it's got to be something in your area. I know white corn is something that some of my northerner producers, the northern part of West Tennessee, some of those get a premium of you know, almost $1 a bushel for going through that. I had some that changed completely and started growing peas, black-eyed peas, and actually made a really, really good crop. And they had a really good market for that, just a couple of counties over from, actually one county over from me. So I would definitely be looking at something alternatively versus doing the same. One key point, and you were talking about margins too, Brent and David, livestock's probably not the time to get in because it's at the highest it's in, but some of the margin calculators I've been doing, the ones that had some livestock, which historically, I'll have to say, historically were a drag to a person's finances. You usually had to supplement that with some other kind of income to make those work. That's actually being the supplement to the row crop operations. Here's one other thing that I would suggest, a couple of things. If you own land, there are a lot of people that hunt that are willing to pay big bucks for leases. I saw that on a few financial statements in the last few weeks. That would be something I would think about. And supplementing the operation with maybe, you know, a W-2 job, doing some custom hire for fellow farmers, anything like that to drive the incomes up to be able to help profitability.
Thank you, Jody. That was a tough one. You did great. Lastly, David, specifically back to your presentation, you talked about options to kind of help you navigate the stress. One of those options was restructuring debt. Do you have any tips or more information on that?
So I think the idea is that maybe we got into a situation where we were a little aggressive in our goals towards our repayments. And so there's that trade-off between how fast do you want to repay that combine that you just purchased, or you purchased a few years ago. And the more you repay it, the more working capital you deplete. Or maybe you bought it without debt, right? So the idea here is the restructure is an opportunity maybe for you to stretch, re-amortize that farmland or that piece of equipment. You stretch it out back, you know, maybe it's 20 years you started with, you paid off 5 years, and you're going to stretch it back out to 20. And so the idea is that that would lower the goal would be to lower your annual payments. And that worked pretty good 5, 6, 7 years ago when we had a declining interest rate environment. So that restructure also kind of came with a built-in mechanism of lower interest rates. And this increasing interest rate environment, there just isn't as much flexibility in that. You might be actually locking in a higher interest rate when you pursue that. And so I think the idea, again, in general, is to you're going to be on the hook for more years of payments and interest expense accruing for those additional years. But the idea is just to right size. And Brent was talking about this before, about profitability being that key engine that drives it. How much can you how much can your operation reasonably sustain in annual debt payments. And so we want to make sure we get that right size. And so that restructuring, that rebalancing of the balance sheet is a way to make sure that we can try to get alignment between what our operations profits can sustain and where we are as an operation today.
Yeah.
Thank you, David. As we're here approaching end of time, do we have anything from our panelists, anything to add before we close? All right. Well, thank you guys for your time. Our attendees this morning, I hope you enjoyed our session from AEI and our team member, Jody Wade, on detecting and addressing financial stress on the farm. This recording will be sent out to those of you who registered, and the AEI team has given us access to the slides as well. So we'll make sure that you guys get that for your own use. Thank you all. Have a great day.
Thank you.
Thank you.